Ever wonder how some ETFs are able to pay 10, 12, even 14% yields without imploding? Today, we're lifting the hood on covered calls to see how that income is generated, where it really comes from, and why volatility is both your best friend and your worst enemy. Fasten your seatbelts, folks. This is going to be a good one. One of the more common questions I receive from viewers is how can covered calls pay so much? Well, today I want to answer that question as we take a deep dive under the hood of those high-paying covered call ETFs. Well, let's start with the basics. A call option is, well, it's simply a financial contract that gives the buyer the right, but not the obligation, to purchase a stock at a set price. That set price, that's what we refer to as the strike price. And of course, they have to do this before a specific date. Now, the seller of that option, they're known as the call writer, and they're going to collect a payment up front, and that payment, that's called a premium. That's where a lot of that money is going to come from, folks. In the case of a covered call, the seller, well, they already own the underlying stock. They're not shorting anything. They're simply agreeing to sell their shares if that stock price rises above, well, that strike price before that date when the option expires. In exchange for taking on that obligation, they earn that premium income. The premium is the first piece of the high yield puzzle. The amount of premium collected depends largely on something called volatility, and that's basically the measure of how wildly the stock price swings around. When markets are calm, option buyers aren't willing to pay much for protection or speculation. So the premiums, well, as a result, they are small. But when volatility rises, uncertainty and opportunity increase. And, well, as a result, buyers will pay much, much more for those very same contracts. For the call writer, that means higher premiums and, well, for that ETF, it means higher income. You can almost think of volatility like the waves on a beach. Small, gentle waves mean fewer people are signing up for surf lessons, but when the waves get big and unpredictable, the surf school suddenly has a lineup out the door. That's the beauty and the danger of volatility. It drives income higher, but it also increases the odds that your shares will be called away if that stock price rises too much. However, volatility, as important as it is, isn't the entire story. When you look at a covered call ETF boasting double-digit yields, that income is coming from two distinct sources. First, you have the regular dividends from the stocks the fund holds, and they can be a significant source of income depending on what the ETF is holding. But the second, and often larger source, is of course that option premium income generated from selling covered calls. Together, they make up the headline yield you see on the fund fact sheet. But it's important to remember that option premiums aren't fixed like dividends. They fluctuate with volatility and market conditions, which means that yield can change over time. This does bring us to an important distinction: the difference between at the money and out of the money covered calls. An at the money, or ATM call, simply means the strike price is roughly equal to the current stock price. These generate higher premiums because there's a greater chance the stock will get called away. The trade-off is that if the stock rises, your upside is capped. You've already agreed to sell it at that strike price. On the other hand, an out of the money, or OTM call, it has the strike price above that current market price. So that does give you more potential for capital appreciation if the stock climbs, but at the same time, it also brings in less premium income up front. You can think of it like renting out your house. An ATM covered call is like agreeing to rent it right now for top dollar, even if that means losing out on a bigger offer next week. An OTM covered call is like holding out for that higher offer, but with no guarantee it'll come. Both approaches make money, but they serve different goals. One prioritizes steady income, the other leans towards potential growth. So which one is actually safer? That depends on what you mean by safe. If your goal is consistent monthly income and lower volatility in returns, at-the-money calls are the safer bet because they provide larger and more predictable premiums. If your goal is total return and capturing more upside during market rallies, OTM calls, well, those are definitely safer in the long run because they let more growth flow through. Ultimately, it is a trade-off between current yield and future opportunity. Covered call ETFs essentially package all of this into a neat, accessible strategy. The fund managers handle the complexities of selling hundreds of covered calls across diversified holdings. Investors, in turn, well, they get the income without the hassle of managing options themselves. But remember, these ETFs thrive best in sideways or slightly rising markets. When volatility is high and prices are choppy, yields look, well, they look pretty darn fantastic. But in a strong bull market, a lot of times these ETFs can lag since much of that upside is traded away in exchange for, well, in exchange for that income. Covered calls aren't magic, and they're not free money. They're simply a way to turn volatility and market uncertainty into, well, into a cash flow, trading some of tomorrow's growth for income today. For income-focused investors, especially those who value stability and cash flow, they can be one of the most elegant income engines in the market. But it's crucial to understand how that engine runs before you decide to take it for a drive. A sub to the channel is the best way to cash in on future content. Now, before we wrap up, there's one more piece of the puzzle we need to talk about. Return of capital, or ROC. It's a term that shows up in the distribution breakdowns of many covered call ETFs, and it tends to confuse even experienced investors. So let's clear it all up. Return of capital isn't the fund handing your own money back to you as well as if it's slowly eating itself alive. That's kind of one of the biggest misconceptions out there. It's not Navarosian either. That's another term that, oh boy, it gets used a lot incorrectly for sure. Instead, return of capital, it's more of an accounting mechanism used when a portion of the distribution doesn't qualify as interest, dividends, or capital gains. For covered call ETFs, that typically happens when the income from option premiums is classified as ROC for tax purposes. It's a way of deferring taxes until you sell your shares, which can make it extremely tax efficient, especially in a non-registered account. Here's the key takeaway. Return of capital doesn't mean your ETF is losing value. It simply means part of the distribution is being paid from realized option income or unrealized gains that haven't been booked as taxable income yet. Over time, ROC reduces your adjusted cost base, or ACB, meaning when you eventually sell, you will pay a bit more in capital gains tax. But you've effectively deferred that payment while enjoying cash flow now, that's for sure. So no, a high level of ROC, it's not going to send your ETF to zero. It's not the fund burning itself down. It's just the way the income is structured for tax reporting. Quite literally, as long as the underlying holdings and the call strategy remain sound, the ETF continues to generate fresh income from premiums and dividends month after month. Hopefully, this video has cleared up some of the mystery surrounding those covered call ETFs. They're really not as scary as some investors might like you to believe, but they are still at the end of the day a tool for income that comes with, well, it comes with trade-offs. Let's continue that learning journey by checking out this video on ZWGD. Thank you for watching, and I will see you in the next video.